Friends, in this video for ithoughtwealth, I'm going to talk to you about success stories of 2020, some observations. There have been a number of companies which are success stories in 2020. There is also a case where some companies which are success stories earlier fell in 2020 only to rise again very quickly. These are companies which have metrics that look very attractive to us. Their business fundamentals look very decent. In an era where growth was scarce or not very evident, these companies gave us growth. They had reasonably predictable margins, and their return metrics, their ROEs and ROCEs, look very respectable. Naturally, these companies were looking more attractive to investors, and the more they got discovered by investors, their valuations looked even more interesting to people. And as the valuations went up, more people went behind them. Overall, there is nothing that you can object to in these companies. But there is something that you need to be aware of about the investing in these companies. Typically, many of these companies have been brought to the capital market in a way which engineered higher valuations. From the investment banking stage, there is a design not to create high float. First, the instrument preferred was a 10% IPO. So when you only sell 10% of the IPO of the shares in an IPO, then 90% is held by the promoters and they have time to dilute further. So in this period itself, the company performs well, people become more cognizant of its strengths, the story is built, and the aura around the company starts growing. A few people corner the float. It's very easy to corner a good part of a 10% float in public ownership, and the valuation goes up. This sets it up very nicely for the promoter to sell the next tranche at a higher valuation. Since a lot of institutional investors have been waiting to get in, they get in at a higher valuation and again corner whatever float is offered to the public. This pattern has happened in a number of IPOs. I'm clearly saying that these are good companies, but the way in which their valuations have been engineered is certainly not the right thing in my opinion. The engineered approach to valuations is what institutions have preferred. It's very convenient to them because they don't see volatility in their NAV. They're able to buy large parcels and just sit tight on them. There's not much of maintenance effort after they have made their investments, and this is sustainable for them because further supply in that company is not going to come very soon because the promoter is not necessarily going to dilute. Typically, this also happens in another set of companies, not just companies where there is a 10% floating stock. It has also happened in companies where there is 75% promoter ownership and the balance is only with the public. So, where promoters own a very high percentage in a company, there too you have seen people cornering the float, whatever. Suppose there's 26% float, somebody goes in and corners a very high percentage. In some extreme cases, it is as high as 10%. Typically, mutual funds are guilty of this. PMSs are no less guilty. So, our individual investors could also buy a very high percentage of the public float. So, this float cornering also happens where there is 25-26% public float. Typically, what happens is people are not acting in concert, but they are investing in concert because one big guy gets in, then others see that he has already cornered a lot of shares, then he buys more, then another guy gets in. So, in these kind of stories, after a while, there is no floating stock. Imagine these investors who have got in early coming out and extolling the virtues of these companies every day on television or periodically in their newsletters or whatever way they can do it. Or even the TVs may pick it up because the price starts moving, they start picking up the companies whose price moves and that gets, highlighted. Then retail rushes in and they become the guys who inflate the valuation from very high to absurd. So, in a way, in both cases where IPO is only for 10% initially or where the public float is 25-26%, we are seeing valuations being engineered and taken to levels which are abnormally high, sometimes even vulgar, and the retail investor coming in to buy these companies. There is another thing also which is happening, and which is why I have been a critic of this model of investing. The small cases will automatically pick up these companies because their metrics are very good, and then retail investor will go in the small case and buy these companies at astronomical valuations. This is the tertiary layer. First the informed guys buy, then it gets into the second layer of informed guys, and then to the periphery, and lastly retail. So this whole thing is stacking up in a way which eventually may not end well, or in a best case situation may lead to long time corrections in the hands of retail public. Most people don't understand this. When we say that something happening in the market ecosystem is not in the favor of the investor, most people tend to associate that opinion on the company in which it is being spoken about. There is no problem with the company. There is a serious ecosystem problem. And unless as a retail investor you understand how the darker corners of an ecosystem work, you become the final product. If you don't realize that you are running the risk of becoming the product, that is not going to help you or your investing. It's in this spirit that I'm highlighting these issues. Do consider them, evaluate these opinions, and then deal with them as you think is best suited to you. If you like this video, do share it with your peers who are avid investors, active learners in the equity ecosystem, and stay tuned on this journey with us on iThoughtWealth. Thank you.